Welcome to episode 23 of the SaaS Report. I'm your host, Matt Aird, and today we're going to be taking a look at Q2 results from ServiceNow and Pegasystems, and then we're going to do a deep dive on Palantir. They've had an interesting ride since going public in 2020. So what we're going to do is compare their performance to a cohort of other companies that IPO'd in the same year to see what they've done differently to achieve a 100x ARR multiple today. So let's get into it. When you have CAC payback of 70 months, you're in a situation that is not so ideal. That's the situation that Pegasystems finds itself in at the moment. Over the last 12 months, they added $108 million in net new ARR, but they spent $545 million on sales and marketing to generate that growth. Over the last 12 months, though, they have made some efficiency gains in the business. Operating income was up 33% to $17 million for the quarter. That came from slight reductions to both sales and marketing and R&D spending as a percentage of revenue. They had 22% free cash flow margins and $240,000 in ARR per employee, which is probably a little bit lower than you'd like to see for a company that's at $1.3 billion in ARR right now. But their biggest concern is their growth rate. As we can see in this chart here, it's been all over the place over the last 3 years, from as high as 30% right down to just 9% in the most recent quarter. As a company at just over $1 billion in ARR, they're going to need to find a way to push that up to at least the low 20s in order to get back to a more respectable ARR multiple. They're currently trading at about 7.7 times ARR right now. Right, moving to a company that doesn't have growth problems, and we're going to take a look at Q2 results from ServiceNow. So ServiceNow added $2.3 billion in net new ARR in just the last 12 months. They are an incredible example of a company that has just found a way to continue growing ARR at significant rates year after year, even after surpassing $12 billion run rate. So they grew ARR 22% year over year from 10.2 to $12.5 billion. And remarkably, they did this with CAC payback of just 23 months. One of the undefeated trends in SaaS companies is that as ARR scales, CAC payback rates scale with it, right? There's almost no situation in which the next 100 million or the next billion in ARR is cheaper to generate than the prior 100 million or 100 billion. It's almost inevitable that as ARR grows, right, CAC payback rates grow with it. But as we can see on this chart here from ServiceNow, they've done a remarkable job at keeping CAC payback rates in check, right? If we rewind all the way back to when they were at 2.5 billion in ARR, they had CAC payback of 23 months. Right, fast forward to today at 12.5 billion and they're at the same rate, right? Just finding a way to continue grinding it out without sales and marketing expenses going through the roof. Operating margins were also up year over year as well, from 9% to 11%. That was driven by reductions in all three major OpEx categories. So R&D, sales and marketing, and G&A spending were all down as a percentage of revenue. S&M was down to 35% from 37%. R&D was down to 23 from 24, and they reduced G&A spending from 9% down to 8% over the last 12 months. Free cash flow margin came in at 16%. That's up from 13% a year ago. So they generated $526 million in free cash flow for the quarter. RPO was up 28% year over year as well. So that's now at $23.9 billion. And they're trading at a market cap of just north of 200 billion, or about 17 times ARR. So Palantir has become a bit of a meme stock over the last, call it 6 months. And the reason for that is that their market cap has absolutely exploded. They're trading at a market cap of $372 billion right now. And they only have 3.5 billion in ARR, right? That was their number as at Q1. So they're trading about 100 times Q1 ARR, which is outlandish for a SaaS company, even one that's growing at a decent clip. Now, because of this and some of the other publicity that they've received due to some of their involvement in, let's call it, geopolitical situations, which is outside the scope of this podcast. We won't get into that too much, but safe to say Palantir has been in the news a lot recently. And so what I wanted to do was take a look at the company's history and see if there are some lessons that we can learn in terms of how they've been able to generate such a big increase in enterprise value over the last couple of years. Because if we rewind 2 or 3 years, right, Palantir just wasn't a company that people spoke about. And as we get into some of the metrics here in the next little bit, we'll see why that was the case. But all of a sudden, they're everywhere, right? They're trading in a ridiculous multiple. They're in the news. Alex Karp is everyone's favorite or most hated CEO, depending on what side of the fence you sit on. But I thought it would be good to do a bit of an analysis on them. And the way that I wanted to do it was I wanted to compare them to a cohort of companies that also went public in 2020, right? So the interesting thing about that time period, unlike today, was that we had a lot of SaaS IPOs. And so I picked a couple of the companies that are probably familiar to you guys to compare them against. And so those comparison companies are ZoomInfo, Asana, Snowflake, and BigCommerce. So what we've done is we've taken the metrics from those 4 companies and compared them to Palantir's from that IPO period in 2020 through to today. So we're going to get into that in a little bit, but first off, I just wanted to do a bit of a recap on Palantir's background for those of you that aren't that familiar, because I think it's actually an interesting story. So the idea for Palantir was conceived by Peter Thiel in the early 2000s. So he was obviously part of the PayPal Mafia, one of the key members of the PayPal founding team. And he had this insight that the techniques that PayPal were using for fraud detection could be applied to help intelligence analysts find terrorists, right? And do that in a way that kind of maintained privacy controls. So he incorporated the company in 2003, and he brought in a small kind of group to found that with him. So Alex Karp, who was a Stanford law classmate, he's the current CEO of Palantir. And then PayPal engineer Nathan Giddings also joined the team. And then there were 2 young Stanford graduates, so Stephen Cohen and Joe Lonsdale. So Joe Lonsdale has gone on to be one of the most prolific tech entrepreneurs of the last couple of decades, part of a bunch of founding teams, a successful investor as well. So he kind of has his own story, but he was part of this Palantir group early on. Now, the idea behind the company was to see if they could use AI to see patterns across a bunch of messy data, right? Without turning that into kind of like a surveillance free-for-all, right? So the idea is these intelligence analysts have access to a bunch of data. How can we use that data to inform who may be a terrorist and who likely isn't based on that available data, and do that in a way that kind of keeps people's privacy in check? So the unique insight that they had was that rather than selling an off-the-shelf AI that makes decisions on its own, they had the view that, the people that they were trying to catch, right, terrorists, fraudsters, insurgents, they would figure out a way to defeat kind of like a purely automated system, right? So if it was just based on an algorithm, the people that they were trying to catch would catch on to the way that this algorithm worked and change their behavior in response to avoid detection. So the software's job was to basically ingest data from a lot of different places, keep rigorous permissions and audit trails around who was accessing that data, and then put an intelligence analyst in the driver's seat to basically test a hypothesis, collaborate, and then act on the insights. And that philosophy became kind of like the building blocks of Palantir's first major platform. So this was called Gotham, right? And Gotham was targeted on counterterrorism, military intelligence, and law enforcement use cases. Now, in Palantir's early days, they actually had a lot of difficulty raising money. I saw a podcast interview recently where Joe Lonsdale was talking about the difficulties that they had trying to get investors to give them money. So they had to be pretty scrappy early on, just in terms of how they were spending money and the investments that they were making into product and sales and marketing. Right, fast forward a few years and they start to have some real world success in government applications, specifically in terms of in combat zones, right? So in 2008, Gotham started to help US military intelligence on campaigns in Iraq and Afghanistan, and was extremely important in helping them to kind of stitch together mundane signals around things like, roadside bomb reports, cell tower pings, vehicle sightings. And they use that to map kind of improvised explosive device networks, and then use that information to then find the bomb makers in those countries. Fast forward to today, and those same government applications are kind of in use. So it's like counterterrorism, counterinsurgency, military applications. And then over the last few years, the corporate use cases are becoming much more prominent as well. So they're having much more success penetrate corporations, helping them to ingest all of their data and help them make decisions, right? And so one of the use cases that's on Palantir's website at the moment is you can use Palantir's system to figure out what to do in response to tariffs, right? So you can pull in all of the information around suppliers and customer data and competitive information. The AI will ingest all of that and then provide recommendations to you on what would happen if you were to take certain actions based on the tariffs that would be put in place, right? So the idea here is that this is a powerful AI that kind of augments human decision making to allow you to kind of like model what would happen if you were to make a certain decision and give you kind of insights and advice around perhaps what the best course of action is to take. All right, so now let's fast forward to 2020 and the company is ready to IPO. This was a really good time for tech IPOs. So unlike climate that we're in over the last kind of 12 to 18 months, 2020, we had a bunch of them, right? So Snowflake, they went public in September with ARR of 600 million. ZoomInfo went public in June of that year at about 500 million in ARR. Asana went public in September at 235 million, and BigCommerce went public in August at about 170 million in ARR. So what we're going to do is we're going to roll up the performance of those 4 companies. You'll use them as the control group in a sense, and compare them to Palantir across the time frame from 2020, their IPO, through to today. So the first thing I wanted to look at was the capital allocation decisions, right, that these companies made. So how they thought about allocations to sales and marketing and R&D budgets. And what we'll do is we'll start with R&D spend. So what we can see in this chart here is that Palantir was actually quite conservative when it came to R&D spend. Aside from the outlier in Q3 of 2020, which was the quarter that they went public, they basically never spent more than 25% of revenue on R&D. And the control group, in contrast, averaged about 35% of revenue spent on R&D. When it comes to sales and marketing spending, we can look at this chart. Palantir averaged about 40% of revenue allocated to sales and marketing. The control group, on the other hand, averaged 51%. Now, both the control group and Palantir, what we see is a decrease in spending on sales and marketing over time. And this is pretty typical, right? We typically see as companies scale ARR, allocation or budgets to sales and marketing tends to reduce over time. Now, the fact that Palantir was spending less on R&D and less on sales and marketing meant that they had, obviously by default, kind of stronger operating margins, right? So both groups, so the control group and Palantir, have an up and to the right trend here. So operating income or operating margins improving over time. But Palantir really started to pull away at the end of 2021. And when we look at free cash flow margins, right, the outperformance here by Palantir is again kind of equally clear. We can see that in financial year 22, the two trend lines come together. And then from that point outwards, Palantir is accelerating free cash flow generation at a pretty strong rate. And the control group is kind of a lot flatter on this metric. So they averaged about 25% free cash flow margins compared to 6% for the control group. So much better at turning revenue into free cash flow and operating income, right? This becomes even clearer when we look at this from a free cash flow generated perspective. So over the last 4 years, Palantir has generated in excess of 2.3 billion in free cash flow, right? So to recap on what we've learned so far in terms of capital allocation, Palantir was much more fiscally conservative from the point of IPO over the last few years, right? They spent less on sales and marketing, they spent less on R&D, they had stronger operating margins and generated much more free cash flow. So that fiscal conservatism, let's have a look at how that translated into impacting growth rates for the organization over the last few years. Now, this is a really interesting chart, right? What we can see is that both the control group and Palantir start out red hot, both growing north of 50%. Then in Q2 of 21, growth rates for Palantir start to slow pretty significantly, right? And ARR growth declines from 50% down to about 13% in Q2 of 2023. So for the control group, we see an acceleration post IPO. So the cohort median growth rate got up to 67% a couple of quarters post IPO. And then they too start to see a deceleration, right? But by Q2 of 22, there's a really big disparity here, right? The control group is growing about twice as fast as Palantir at this point. So Palantir's growth, right, that bottoms out in Q2 of 23 at about 13%. And then the reacceleration begins. And as at Q1 of 25, they've been able to generate an increase in ARR growth rates for the last 7 quarters, while the control group, it's been down and to the right, with growth rates hitting just 9% and 8% in Q3 of 24 and Q1 of 25 respectively. So, right, this is largely the defining chart behind the story that is Palantir today, right? They've found a way to grow faster quarter after quarter in an environment where everyone else is struggling just to maintain growth rates. And this is one of the big reasons that they've been able to achieve such a high ARR multiple, right? Because when growth is hard to come by, right, those companies that are growing are rarely able to capitalize on that. Now, growth obviously is just one component of a company's valuation story, right? The other is free cash flow margins. And we have 2 metrics that combine growth and free cash flow rates to help us figure out what a company should be worth, right? And those 2 metrics are Rule of 40 and Rule of X. So let's take a look at the trends in those 2 metrics over the last couple of quarters. So we'll start with Rule of 40. As a refresher, Rule of 40 combines free cash flow margins and growth rates, right? So if you had a free cash flow margin of 13% and a ARR growth rate of 26%, you would have a Rule of 40 of 39. You simply sum those 2 numbers together. Now, what we can see in this Rule of 40 chart here is that the control group largely outperforms Palantir up until about Q2 of 2023. This was largely driven by the growth rate disparity that we saw in the previous chart. And then from that point on, the 2 charts diverge pretty significantly. So with the peak difference occurring in Q4 of last year, so Palantir reported Rule of 40 of 91, and the control group came in at just 23. So this again was driven just by the large increases in ARR growth that Palantir has been able to drive over the last few quarters, right? And we just haven't seen that from almost any other public SaaS companies over the last few years. Right, Rule of X, this is another metric that helps to provide some guidance on how a company will be valued in the public markets. For those of you that haven't come across Rule of X before, it's similar to Rule of 40, right? We take free cash flow margin and ARR growth rates and we combine the two. It's just that in Rule of X, the growth rate gets a 2x multiplier, right? So in the same situation that we used before, if you had free cash flow margin of 13% and a growth rate of 26, right? Your Rule of X would be 26 times 2, which gives you 52, plus 13, right? Which gives you 65, right? So you'd have a Rule of X of 65 and a Rule of 40 of 39 in that situation. So let's take a look at the Rule of X chart and see how they've stacked up. Right, this chart obviously takes pretty similar shape to Rule of 40, but we see the differences kind of like amplified. So the outperformance by the control group early on is magnified, and then the outperformance by Palantir over the last kind of year and a half, 2 years is amplified as well. Now, keep in mind here, Palantir achieved a Rule of X score of 127 in Q4 of 24. Now, Bessemer Venture Partners, the people who invented this Rule of X metric, say that a score of 70 is outstanding, right? So that just puts in context the performance that Palantir has been able to generate in the last little bit, right? So the growth story here is pretty clear. Palantir struggled to grow at the same rate that the other public SaaS companies did kind of in the, call it the COVID boom era, right? They really struggled to generate the same rates of growth that other companies did during that period. But they've found a way to actually re-accelerate growth over the last couple of years when most companies have struggled, right? Now, what I want to do is have a look at how go-to-market efficiency may be a factor in this story as well. So let's look at CAC payback rates first. So again here, it's kind of a tale of two halves. We've got Palantir underperforming the control group early on. So between Q4 of 20 and Q2 of 23, Palantir averaged CAC payback of 27 months. The control group over the same time period averaged CAC payback of 21 months. And then as we can see on the chart, right, performance rates here flip. The control group loses control of go-to-market efficiency and it blows out to 110 months in Q1 of 24. And then they get to rein it back in somewhat and it settles at about 57 months. Palantir, on the other hand, gets more efficient every quarter from Q2 of 23. So they recorded CAC payback of just 12 months in Q1, just gone, right? Now, the degree of difficulty here shouldn't be underestimated. Companies almost never have decreasing CAC payback rates over time. As we talked about in the ServiceNow breakdown earlier in this episode, right? It's almost always the case that as ARR grows, CAC payback grows with it. So the fact that Palantir has been able to reduce CAC payback periods whilst increasing ARR growth rates and ARR generally is outstanding. So for context, right, Palantir has lower CAC payback at $3.5 billion than they did when they were at $1 billion in ARR. Now, to compare that to some other companies, right, at $1 billion in ARR, HubSpot had CAC payback of 20 months. Once they got to $2.5 billion, that had ballooned out to 35 months. Right, CrowdStrike, pretty similar story. At $1 billion in ARR, CAC payback was 13 months. When they got to $3.5 billion, that was up to 21 months. Atlassian was at 10 months at $1 billion, and they were at 15 months at $3.5 billion. It's extremely unusual for a company to have a large ARR increase and be able to reduce their CAC payback period. Right, last one I want to finish on here is ARR per employee. So this is one where Palantir absolutely dominates from start to finish. So they've always been exceptional at scaling ARR without scaling headcount. And the big inflection point here where they started to run away from the control group happened in Q3 of 22. So this is where the rest of the SaaS landscape all of a sudden found it really hard to grow and Palantir was off into the races. Now Palantir is at the point where they're generating about $1 million in ARR per employee, which is exceptional. Right, so in conclusion, if you had to assess Palantir in the height of the SaaS boom, right? So kind of like rewind to 2021. You would have been looking at a company that was like fairly underwhelming, to be honest, right? They were growing slower than most of their peers. They had worse go-to-market efficiency. And you can make the argument that they were perhaps being too conservative when it came to capital allocation, right? They weren't spending enough on sales and marketing. They weren't spending enough on R&D, and they were probably missing the boat. Fast forward to the second half of 22 and then into 2023, and they really started to hit their strides, right? So then we get that inflection point. Growth starts to accelerate, go-to-market efficiency improves, free cash flow margins accelerate as well. And they're just running away from their peers, right? While everyone else is kind of stuck and stagnant and looking to get back some way or another to low 20% ARR growth rates, Palantir is just accelerating through all of those marks. Now, does that justify a 100x ARR multiple on their Q1 ARR? Probably not, but let's try to put it in context, right? So at 100 times ARR, they're valued at about 350 billion right now, market cap of 350 billion. Salesforce is doing 40 billion in ARR and only have a $250 billion market cap. So Palantir's market cap is $100 billion greater than Salesforce's, and they're doing less than a tenth of the revenue. Right now, Salesforce is growing at about 9%. Palantir growing much faster than that. But if we were to maintain their current growth rate, so let's say Palantir finds a way to continue growing at 40%, and Salesforce continues growing at 9% over the near term, it would take Palantir 10 years to catch up to Salesforce in terms of ARR run rates, right? So they have to grow at 40% for 10 years to catch Salesforce if Salesforce continued growing at 9% year over year. So in my view, right, just on that alone, right, the stock price is a little bit frothy. CEO Alex Karp, he might agree with that analysis as well. So he's sold about $1.9 billion worth of stock over the last 12 months. And the other little kind of like wrinkle driving this obviously is that Palantir's performance is often correlated with kind of like geopolitical instability, right? So you've got over the last couple of years, you've got the Russia-Ukraine war, you've got the war in Gaza, which has likely led to a large increase in the demand for Palantir's services. They would counter that by saying, look, we're generating a bunch of traction in like corporate applications and use cases as well. And that market's largely untapped for us. And if we continue to deliver there, right, that market's significantly larger than kind of the government market for us, right? Which could be true, but it's still early days, right? They're only at 3.5 billion in ARR. So they've still got a long way to go kind of generate those outlandish valuations in my view. So probably a meme stock, but fun to look at nonetheless. Hope you enjoyed that episode today. That's it for this week. If there are other companies you want me to run a breakdown on, let me know. Happy to do it. I will see you here again next week. Until then, goodbye.